This is an analysis from Alpha Business Media.
Imagine for a second that you are standing on the edge of a gorge in Nepal. You can hear that roar of the water below you.
Oh, yeah.
It's powerful, it's relentless, and for decades, that sound has really been the soundtrack of a national dream.
The battery of South Asia.
Exactly. The narrative is so simple. We have the rivers, we build the dams, we generate the power, and we sell it to our hungry neighbors, India and Bangladesh. It feels like a perfect setup.
On paper, it absolutely is the perfect setup. And, I mean, to be fair, we have made progress. We're not sitting at zero.
Right. We've hit about 2,800 megawatts of installed capacity. I mean, in the wet season, we are actually exporting electricity. So if you're just looking at the headlines, it looks like a boom. It looks like a success story.
It does, but, we aren't here to read the headlines.
No.
We're here to read the balance sheets. And if you pop the hood on this so-called boom, you realize that the engine driving it, the domestic financing system, it's effectively seized up.
Seized up? That's a violent image for a banking system.
It's appropriate, though. The source material we're diving into today argues that we are standing on what it calls a fiscal precipice.
A fiscal precipice.
Yeah. The government has this huge target to build another 5,000 megawatts. But the analysis suggests that financing that next 5,000 megawatts, well, using the current method, it's mathematically impossible.
Mathematically impossible. Not just, difficult, impossible.
That is the claim. Because the local banks, they just cannot carry the load anymore. So our mission today is to unpack three specific things. First, we need to understand this great wall of domestic lending, why the vault doors in Kathmandu are effectively shut for big hydro.
Okay.
Second, we'll look at the multi-trillion-dollar alternative that's just waiting in the global market, green bonds.
Right.
And third, and this is the really sticky part, we need to talk about the one specific passport Nepal needs to actually get access to all that money.
Okay, let's start with that Great Wall. Because I'm looking at the banking sector reports from the source material, and I'm a little confused. Nepal's commercial banks seem flush with cash.
They do.
They're holding something like 5.5 trillion Nepali rupees in deposits. Now, to a layman like me, that sounds like a mountain of money. If the banks have 5.5 trillion rupees, why can't they just lend it to build the dams?
It is a mountain of cash, you're right. But this is where we have to make a distinction between having money and being allowed to lend money. Banks are businesses, sure, but they are highly regulated businesses.
Of course.
They don't just get to empty the vault every time a developer walks in with blueprints. They are tethered to the credit-to-deposit ratio, or the CD ratio.
Break that down. The CD ratio it's essentially a safety buffer, right?
Exactly. It's the central bank saying, look, you need to keep a certain amount of cash on hand so that when a grandmother comes to the counter to withdraw her savings, the money is actually there.
You can't just lend out everything you have.
You cannot lend out 100% of your deposits. And right now, that ratio is hovering right at the ceiling. We're talking 85 to 90% for most commercial banks in Nepal.
So they're completely maxed out.
They're completely saturated. They've lent out almost every single rupee they are legally permitted to lend. There is very, very little dry powder left in the keg.
So even if they wanted to fund a new dam, they literally do not have the regulatory space to do it.
That's it.
But wait a minute, I remember reading about a mandatory lending rule. Doesn't the central bank actually force commercial banks to lend a specific chunk of their money to the energy sector? I thought there was a 15% rule.
There is, and this is where the story gets really fascinating. That directive to lend 15% of their total portfolio to energy and agriculture, it was originally designed as a floor.
A minimum target.
A minimum target, yeah, to force banks to take these projects seriously. But because the hydropower sector has grown so explosively in the last decade, that floor has effectively become a ceiling.
So they've already hit the target.
Oh, they've smashed through it in many cases. The banking sector has exposure of over 350 billion rupees to energy. Now, put yourself in the shoes of a bank CEO for a second.
Okay.
You look at your loan book, and you see that a huge percentage of your entire bank's existence is tied up in one single sector.
That sounds really risky. I mean, if there's a flood or a policy change or the price of electricity drops.
Exactly. If anything goes wrong in the energy sector, your bank is in serious trouble. So these bankers aren't looking for more hydro projects. They're desperately trying to diversify away from them to protect their institutions.
So what used to be a push from the government to lend has now become a pullback to safety by the bankers themselves.
You got it.
That makes perfect sense. Diversification is banking 101. But let's just say a bank decided to be brave. Let's say they wanted to ignore the risk and lend anyway. Could they even fund the kind of projects we are talking about now? Because we aren't just building small 10-megawatt dams anymore, we're talking about monsters.
Right, we are entering the era of the mega project. And the source material focuses heavily on the Upper Aran project. That's the crown jewel right now.
And that's a big one.
It's a 1,061 megawatt project. The estimated cost is over $1.3 billion US dollars.
$1.3 billion. That is a massive check to write.
It is. And here is the problem. In Nepal, there is a regulation called the single obligor limit.
Okay.
Basically, a bank cannot lend more than a certain percentage of its capital to one single borrower or project. It prevents one bad decision from sinking the whole ship.
Which sounds incredibly prudent. You want that.
It is prudent. You definitely want that rule. But the unintended consequence is that no single bank in Nepal, and honestly, even if you got a consortium of all of them together, they would struggle to write a check for $1.3 billion without breaking those norms.
The domestic banking system is physically too small to digest a meal that big.
That's a great way to put it.
So what happens? Does the project just stall?
Or worse, it gets mutilated. The sources describe this phenomenon where developers start doing financial engineering instead of civil engineering.
What does that mean?
They slice the projects up. Instead of building one massive, efficient 1,000 milliW plant, they might try to break it into, say, 5 smaller 200 milliW cascades.
Just so they can fit the loan limits of the local banks?
Exactly.
That sounds terrible for efficiency. You lose all the economies of scale.
Precisely. You are designing the dam to fit the bank account, not to fit the river.
Right.
And that drives up the cost of electricity for everyone. But there is a deeper structural rot here that we need to address. It's not just about the size of the loans, it's about the timing. This is what the experts call the asset-liability mismatch.
Okay, asset-liability mismatch. That sounds like classic banker jargon. Let's unpack that.
It sounds complex, but it's actually very simple. Think about where a bank gets its money.
From us, our deposits.
From you and me.
Yeah.
Right. We put money in a savings account or maybe a fixed deposit for a year, but we expect to be able to withdraw that money relatively quickly, right?
Right. If I have an emergency, I want my cash today.
That is a short-term liability for the bank. They owe you that money on demand. Now look at a hydropower dam. That is a long-term asset. You pour concrete today, and it generates revenue to pay back the loan over 20, 25, maybe 30 years.
Ah, I see where you're going. The bank is using my right now money to fund a 30 years from now project.
Correct. And that creates a permanent liquidity risk. If there is a sudden economic downturn or a panic and everyone wants their deposits back at once, the bank is stuck.
They can't sell a half-finished dam or a turbine to pay me back.
They are completely illiquid. The source material uses very strong language here. It calls adding more of these long-term hydro loans to the current system systemic imprudence.
Systemic imprudence. Basically, they're saying we are gambling that the economy stays perfectly stable for 30 years so we can pay for these dams with short-term cash.
Exactly. And in a developing economy, betting on 30 years of uninterrupted stability is a very, very high-risk bet.
So let me just recap the grim reality we've painted so far. The banks are tapped out on their credit ratios.
Yep.
They're overexposed to the energy sector already. The projects are getting too big for their balance sheets. And the timing of the loans is dangerous for the stability of the entire financial system. It sounds like we've painted ourselves into a corner.
We have.
If the domestic well is dry, where is the water?
The water, or rather the ocean, is outside our borders.
Ah.
This is where the analysis pivots to the solution: international green bonds.
I feel like I hear the term green bond everywhere these days. It feels a bit like a marketing buzzword. Is it actually different from a regular loan, or is it just a regular loan with a green sticker on it?
It is functionally a bond, an IOU. You borrow money, you pay it back with interest. But there are two critical differences. First, yes, the proceeds are legally earmarked for environmental benefits. And run-of-the-river hydro fits this definition perfectly.
Okay.
But the second difference is the one that really matters for Nepal: the audience.
Who is the audience?
Well, when a Nepali developer borrows right now, they're negotiating with a few bank managers in Kathmandu. When you issue an international green bond, you are selling to the global capital market. You are tapping into pension funds.
Wow.
You're talking to entities like CalPERS, the California Public Employees Retirement System. You're talking to sovereign wealth funds in Norway or Singapore.
And I assume these guys have slightly deeper pockets than the banks in Kathmandu.
Deeper pockets is the understatement of the century. These funds manage trillions of dollars. And here is the key.
All right.
They have a problem that is the exact opposite of Nepal's problem.
Yes.
Nepal is starving for capital. These funds are drowning in it. They need to deploy capital in massive chunks, $300 million, $500 million at a time, just to hit their investment targets.
So a $10 million loan, which is a big deal in Nepal, is actually annoying to them. It's too small.
It's a rounding error. They won't even pick up the phone for that. They want the big tickets. And this matches exactly what Nepal needs for transformative projects like the Upper Arun.
And this solves our bad timing problem from earlier, too.
The asset-liability mismatch. Yes.
How so?
In the bond market, you can issue debt that matures in 15, 20, or even 30 years. You match the bond duration to your power purchase agreement, your PPA.
Ah, so if you have a contract to sell electricity for 20 years, you issue a 20-year bond.
Exactly. You lock in your cost of capital to stop worrying about what the deposit rates in Kathmandu will be next year. It's stable.
That sounds incredibly stable. But what about the cost? Usually foreign money comes with a premium, doesn't it?
Historically, yes. But look at the domestic interest rates in Nepal right now. They are punishing often 12, 13, 14%.
How brutal.
If you issue a bond in US dollars, even with global rates being where they are, you are likely looking at a single-digit cost. Plus, you get access to climate finance funds that are specifically mandated to accept lower returns for green impact.
So let's look at the neighbors. Is anyone else actually doing this, or is this all just a theoretical exercise?
Oh, the neighbors are running laps around us. India is so aggressive on this. Companies like Adani Green and Renew Power are raising billions of dollars this way.
Billions.
They aren't trying to squeeze every rupee out of the State Bank of India. They are going to London, Singapore, and New York. They are tapping the global keg while we are fighting over the dregs in the local cup.
Okay, so the money is there, the model works, the neighbors are doing it. This leads to the obvious question that I'm sure you, the listener, are shouting at your device right now. Why hasn't Nepal done it? What is stopping us from printing these bonds tomorrow?
The missing piece. The source calls it a financial passport.
A financial passport.
It's the sovereign credit rating.
A credit rating. Like a credit score, but for a whole country.
Exactly. Right now, to an institutional investor in Tokyo or New York, Nepal is invisible. Not bad, just invisible. They cannot price the risk because there is no standardized data. Without a rating from one of the big three agencies, Fitch, Moody's, or S&P Nepal is an unknown quantity.
And in finance, unknown equals infinite risk.
Precisely. If they can't measure the risk, they assume it's 100%, which means they won't lend to you at any price. The rating acts as a benchmark. It tells the world, here is the baseline risk of doing business in Nepal.
But I feel like there's a lot of fear around this in Kathmandu. I've heard policymakers whisper, what if we get a bad grade? You know, what if we open our books, pay for this rating, and get a B or a C? Wouldn't that be humiliating? Wouldn't that scare investors away?
This is the single biggest psychological barrier, and the sources spend a lot of time debunking it. A sovereign rating is not a national report card. It's not a judgment on our culture, our history, or our pride.
It's a financial tool.
It's just a financial tool. And here's the reality. A speculative grade, say, a B+, is infinitely better than no rating.
Really? So being a B student is better than not showing up for the test at all?
In finance, absolutely. Look at Bangladesh. They hold a BB rating from S&P. That is not investment grade. In Wall Street terms, that's junk or speculative.
But they have one.
But because they have that rating, it acts as a passport. It allows them to access billions in international capital because investors know what they're dealing with. They can price the risk.
So even a bad rating gives you a seat at the table.
Yes. And crucially, it sets something called the country ceiling.
Country ceiling, what does that mean?
It means that generally, no company in a country can be rated higher than the country itself. So if the government doesn't have a rating, the Nepal Electricity Authority, the NEA, can't get a rating. Private developers can't get a rating. The government has to go first to set the ceiling. Once they establish that benchmark, it unlocks the door for everyone else.
So the government is basically blocking the hallway. Until they move, nobody else can get through.
That's a great way to put it. They hold the master key. Even if the Nepal Electricity Authority is super profitable and well-run, they are locked out of the global bond market because the government hasn't done the paperwork.
This brings us to the strategic outlook. The analysis lays out a fork in the road for the next 24 months. It seems we have two very clear choices. Walk us through them.
The source frames them as Scenario A and Scenario B. Scenario A is the path of inaction. This is the path of least resistance.
Which is sort of where we are now. We keep delaying.
We keep deferring the rating because of political hesitation, And the result, we remain prisoners of domestic liquidity. Hydropower development stagnates.
We just keep building the small stuff.
We keep building small 50 milliW or 100 milliW projects that we can scrape together funding for locally. But the 5,000 milliW target, the dream of being a regional energy powerhouse, it becomes a hollow slogan. You simply cannot fund it.
Because the math, as we started with, is impossible.
Correct. Then there is scenario B, the path of integration. This is where the Ministry of Finance bites the bullet and pursues the rating.
And that's not just filling out a form, right? That involves some pain.
It involves significant pain. It means opening the books. It means international scrutiny of your fiscal deficits, your monetary policy, your governance. It imposes discipline.
You can't just print money to solve a problem if you want to maintain your rating.
Exactly. But the outcome is transformative.
How so? Paint the picture of scenario B for me.
Imagine a benchmark issuance. Nepal issues its first sovereign bond, say $500 million. Even if it's just one bond.
Just to get on the board.
It establishes a yield curve. It tells the world, this is the price of risk in Nepal. Once that price is set, the private sector can price their own debt. It connects the plumbing of Nepal's hydro sector to the ocean of global climate finance.
So suddenly the upper Aran isn't a fantasy. It's an investable asset.
That's it.
It sounds like growing up. It sounds like moving from a cash-based local economy to being a global financial participant.
That is the perfect way to put it. It's about maturation. It's about deciding if you want to be a big fish in a small pond or if you want to swim in the ocean.
So we're coming to the end here, and I want to hit on the hard truth that the source mentions in its conclusion, because usually when projects fail in Nepal, we blame technical reasons. The walk was too soft, or the river flooded, or the contractor was slow.
Right.
But this analysis says the barrier isn't engineering.
No, the barrier is political. That is the hard truth. Securing a rating requires transparency. It requires policy predictability that lasts longer than one election cycle. It means subjecting your monetary policy to global standards of accountability.
And that is terrifying for politicians who thrive on ambiguity.
It is. Ambiguity allows for flexibility, let's call it. It allows you to hide inefficiencies. But the choice is stark. The finance exists. The world is literally looking for green projects to fund.
There are trillions of dollars committed to climate action looking for a home.
But that money will not come to us just because we have nice rivers. We have to build the bridge to go get it.
That is a powerful thought. We are sitting on the resource, the world is sitting on the cash, and the only thing missing is the bridge, the rating that connects the two.
And if we don't build it, we are choosing to cap our own potential. We're choosing to stay comfortable within our constraints rather than expanding our horizon.
It's a choice between the comfort of the known and the potential of the unknown.
That's the one.
A choice between comfort and potential.
Yeah.
That is something for you to think about. The rivers are flowing, but will the capital flow to match them?
That is the trillion-dollar question.
Thanks for listening to this deep dive. We'll catch you next time.